Top three investment options in India right now. Number one, direct equity. Investing in stocks might not be everyone's cup of tea as it's violate asset class and there is no guarantee of return. Further, not only it's difficult to pick the right stock, timings your entry and exit is not very easy. There is only silver lining that is over long period equity has been able to deliver higher than inflation adjusted returns compared to all other asset classes. At the same time, a risk of losing the considerable portion of even of all of your capital is high unless one option for a stop loss method is crucial losses. In stop loss, one places an advance order to sell a stock at a specific price. To reduce the risk to a certain extent, you could diversify across sectors and market capitalization. To direct invest in equity, no one need to open a demand account. Every bank allows opening of three in one account. Number two, equity mutual funds. Equity mutual fund scheme predominantly invest in equity stocks. As per current, the Securities and Exchange Board of India mutual fund regulation, an equity mutual fund scheme must invest at least 65% of its assets in equity and equity related instruments. And equity funds can be actively managed or passively managed. In activities traded fund, the return are largely dependent on the fund's manager ability to generate returns. Index funds and exchange traded funds are passively managed and these tracks are underlying index. Equity schemes are categorized accordingly to market capitalization or the sector which is they invest. There are also categories by whether there are domestic investing in stock only of Indian companies or international investing in stock of overseas companies. Number three, debt mutual fund. Debt mutual fund schemes are suitable for investors who want to steady return. They are less volatile and hence considered less risky compared to equity funds. Debt mutual funds primarily invest in fixed interest generating securities like corporation bonds, government securities, treasury bills, commerce papers, and other money making instruments. However, these risk mutual funds are not risk free. They carry risks such as interest rate risk and credit risk. Therefore, investors should study the related risk before investing.